Nvidia, stock ticker NVDA, hit a new all-time high this week, reaching $662 per share. The stock is up 37% year-to-date after soaring 240% in 2023. With its current dominance in the AI boom, an important question emerges. Should you join the rally and ride Nvidia's wave of AI domination, or are there signs of a bubble in the making? In this video, we will answer this question by analyzing the Nvidia stock, reviewing important financial metrics, comparing the stock's performance against competitors, and assessing the stock's dividend safety. By the end of the video, we will run the numbers through our valuation model, deciding on an acceptable buy price, considering the risks associated with the company, and I'll also share with you my strategy and what I've been doing with Nvidia in my own portfolio. Before commencing our analysis, I first want to welcome you all to Investopia, where we discuss everything finance. I also want to share a friendly disclaimer. Please remember that this is not financial or investment advice, and that you should always do your own due diligence and make decisions based on your own circumstances. With that being said, let's get right into it. Founded in 1993, Nvidia is a multinational technology company that designs graphic processing units, application programming interfaces, and system-on-a-chip units. As the world's most dominant supplier of artificial intelligence hardware and software, Nvidia is currently the biggest winner of the generative AI boom. More than 40,000 companies around the world, including tech giants like Alibaba, Amazon, Microsoft, and Google, use Nvidia's AI technology to power their AI operations. A notable example is ChatGPT, which is an advanced conversational AI model developed by OpenAI and powered by Nvidia's DGX AI supercomputer that was able to reach 100 million users in just 2 months, making it the fastest growing app in history. At the time of filming this video, Nvidia is a mega cap company with a market cap of $1.6 trillion. It is trading at a price to earnings ratio of 87.4 and has a tiny dividend yield of 0.02%. Looking at the stock's performance over the last 5 years versus the S&P 500, we can see that Nvidia blew the S&P out of the water, increasing 1,686% since February 2019, while the S&P increased 83%. Last year alone, Nvidia soared 214%, while the S&P increased only 20%. Now, when comparing its performance with its competitors, Broadcom, AMD, Intel, and Qualcomm, over the last 5 years, we'll notice that the entire industry has been booming. Nvidia still came out on top, with AMD coming second with a 671% return. Broadcom and Qualcomm trailed with 347 and 182% respectively, while Intel is the only one that had negative returns, decreasing 13% since 2019. Moving on to Nvidia's financial statements, we can see that revenues grew from $12.4 billion in 2018 to $44.9 billion in the trailing 12 months. That's a CAGR, or an average annual growth rate, of 36.9%. Similarly, we can see that net income increased from $4.7 billion in 2018 to $18.9 billion, which is a CAGR of 40.6%. Now, unlike revenues, which consistently increased year to year, net income did experience a couple drops in 2019 and 2022. However, despite the slight inconsistency, over the 5-year period, Nvidia was able to quadruple its net income, which is amazing to see for such a mature company. As for the balance sheet, we see that the cash balance in 2018 was $7.6 billion and increased to $18.3 billion in the trailing 12 months. Current assets, which also includes the cash balance, increased from $11.4 billion to $32.7 billion, which is a CAGR of 29.4%. Net debt, which is the sum of short and long-term debt minus cash and cash equivalents, decreased from negative $5.6 billion in 2018 to negative $7.3 billion. That's an average decrease of 6.5% per year. Now, as we discussed in our last video with Alibaba, these negative net debt values are a result of Nvidia's cash balance being higher than all the company's debt combined. So this negative $7.3 billion that you see here basically means that Nvidia has enough cash on hand to pay off all the company's debt and still have $7.3 billion left over, which is truly remarkable. Now, Nvidia's dividend yield is pretty insignificant, so I won't be spending too much time on it, but I'll still go through the metrics just in case someone's interested to know. Nvidia has a dividend safety score of 89 out of 100, which gives it a very safe rating and means that a dividend cut is highly unlikely. It has been paying the dividend for the past 10 years without a reduction, but surprisingly they have stopped increasing the dividend in the past few years. Despite the freeze, the dividend has been growing 24% per year in the last 10 years and 2% in the last 5 years. As we can see here, Nvidia's dividend yield is lower than its 5-year average of 0.11%, which could possibly indicate overvaluation. On the other hand, Nvidia's forward PE ratio of 34 is lower than its 5-year average of 41.3, indicating possible undervaluation. However, as always, we should not look at any metrics in isolation and will only make conclusions by the end of the video. Both the earning and free cash flow payout ratios are consistently under our preferred 60% threshold. In 2023, the earnings payout ratio was at 5%, while the free cash flow payout ratio was at 10%, with both expected to drop to 1% in 2024. Shares outstanding have increased from 2.4 billion shares in 2014 to 2.5 billion shares today, meaning that Nvidia has actually been issuing new shares and diluting existing shareholders. It's nothing significant, but we generally prefer to see declining shares, as it signifies that our ownership stake in the company is getting bigger and that the company's profits are being distributed on less and less shareholders. Now, coming to Nvidia's return on equity and return on invested capital, and just in case you don't remember, a high return on equity usually signifies a company's moat, while the return on invested capital reflects management's ability to effectively allocate and reinvest capital. Generally, we like to see a minimum of 10% for both metrics. However, as I always mention, the thresholds could change slightly depending on the industry. For semiconductor firms, we prefer to have higher thresholds of 15% for return on equity and 12% for return on invested capital. As you can see here, Nvidia's return on equity is generally over our threshold. It did drop lower in the first 3 years from 2014 to 2016, but over the 10-year period, it averaged 28.4%, which is good to see. Similarly, the return on invested capital is mostly over our preferred 12% threshold, except for 2014, averaging 20.5% over the 10-year period as well. Now, you'll also notice that both metrics soared to all-time highs of 69 and 46% in the trailing 12 months, as a result of the AI boom and the inflated demand on Nvidia's products, which is great to see, but you should always consider whether these levels are sustainable moving forward. In terms of operating and free cash flow margins, and other than a small dip in 2014 for operating margin, Nvidia has been comfortably able to surpass our 16% threshold for semiconductor firms, averaging 25.1% since 2014. Likewise, free cash flow margins is consistently over our 5% threshold, averaging 25.4% over the 10-year period. And again, consistent with what we saw before in other metrics, you'll notice that both margins have surged recently to all-time highs. As for net debt to EBITDA, net debt to capital, and interest coverage, and as we observed previously in the balance sheet, you can see that Nvidia has virtually no debt. If they wanted, the company can pay off all the debt owed with the cash on hand and still have over $7.3 billion of cash remaining, which is remarkable. Now, before moving on to our valuation models, let's first check how Nvidia performed in the last recession of 07-08, especially with the ongoing speculations of another recession happening in the near future. As we can see here, Nvidia did not pay a dividend during that time, as it only started paying a dividend 10 years ago. Their sales decreased by 35.4%, which was below average growth when compared with other companies during that time. And finally, the stock tumbled 78% during the recession, which is a much more substantial drop when compared with the S&P 500, which declined by 55%. So just based on these numbers, Nvidia does look to be more susceptible to economic downturns, which is something worth considering if your base case scenario involves a recession happening in the next few years. Jumping into our valuation models, we'll be reviewing 4 distinct models to get to our intrinsic value and acceptable buy price. If you're enjoying the content so far, please smash the like button and subscribe to the channel to ensure that you're notified once we release similar videos in the future. Our first valuation model is the discounted free cash flow model, where we estimate Nvidia's intrinsic value based on the present value of their estimated future cash flows. We can see here the free cash flow that Nvidia generated over the last 10 years, growing at an average 30.4% per year. Based on analyst estimates, we use a 42.5% growth rate for future free cash flows. Now, I personally believe that in the near future, Nvidia will likely be able to generate higher free cash flow as they address the surging demand for AI chips. However, on the long run, sustaining these high growth rates may prove challenging for a $1.6 trillion company, leading to an eventual restabilization of growth rates to more normal levels. Using an 8% discount rate, which is also our desired rate of return, we get the present value of all future free cash flows as well as our terminal value. Adding them together, plus cash and cash equivalents minus total debt, we get our enterprise value, which is the estimated total value of the company in 10 years. Dividing the enterprise value by the total shares outstanding, we get a fair value of $430 per share, which is lower than Nvidia's current price of $662, indicating overvaluation. The second method is the multiples valuation model, where we obtain Nvidia's fair value based on the multiples of its competitors and companies within the same industry. We do so by getting their current PE multiples, calculating the average PE, and multiplying it by Nvidia's current earnings per share to get our fair value, which is $368 per share. Now, you'll probably notice that I did not include AMD in this valuation model, because its PE ratio is currently 335, which is 600% over its 10-year normal PE, so including it would have skewed our intrinsic value estimation. The third method is the dividend discount model, where we estimate Nvidia's fair value based on the present value of future dividend payments, specifically used for dividend-paying stocks. Now, as we saw earlier, Nvidia hasn't been increasing the dividend at all since 2018, so we can't really use this model to value Nvidia, and we'll have to eliminate it from our final valuation. The last method that we will review today is the historical multiples valuation model, where we estimate Nvidia's fair value by considering the normal PE ratios that the stock traded at historically. In our analysis, we will use 5, 10, and 20 years normal PEs. As we can see here, the Nvidia stock was trading at an average 49.3 PE during the last 5 years, 39.2 for the last 10 years, and 35.1 in the last 20 years. We calculate their average and multiply it by Nvidia's current earnings per share to get our fair value of $313 per share. Finally, to obtain our intrinsic value and acceptable buy price, we take the average of the 3 fair value estimates generated by our models. The intrinsic value we get is $371 per share, which is much lower than the current stock price. In fact, our estimated intrinsic value is 44% lower than the current price. So without a margin of safety, you would need the stock to drop 44% just for it to be a buy today. However, as we always say, you always want to have a margin of safety to protect against downside risk. For high-quality companies with a white moat, strong balance sheet, and good forward-looking data, a 10% margin of safety could be justified. With a 10% margin of safety, our acceptable buy price would be $334, which is 50% lower than the current price. In other words, to buy Nvidia with a 10% margin of safety, the stock would need to drop in half. Now, you might be wondering, how does this make sense? How could the company best positioned to capitalize on the AI boom be so overvalued? Well, the answer is actually pretty simple. Benjamin Graham, who was Warren Buffett's professor and mentor, once said about the stock market, and I quote, "In the short run, the market is a voting machine, but in the long run, it is a weighing machine." Graham meant that in the short run, price fluctuations are driven by emotions and consumer sentiment, or popularity. However, in the long run, the fundamentals of the company is what actually determines the stock valuation, hence the weighing machine. So yes, Nvidia is surely benefiting from the AI boom and growing at rapid rates, but are the company's fundamentals growing at the same rate as the stock price? Going back to our financial metrics, as we saw before, over the last 5 years, revenues increased from $12.4 billion to $44.9 billion, which is a 261% increase, while net income increased from $4.7 to $18.9 billion, which is an increase of 302%. At the same time, the stock increased 1,686%. So you can clearly see that despite the increases in revenue and income, the growth is nowhere near the growth of the Nvidia stock price, which demonstrates Nvidia's current biggest risk, overvaluation. Additionally, Nvidia does not manufacture its own chips. It actually relies on the Taiwan Semiconductor Manufacturing Corporation, or TSMC, to develop its designs. TSMC is the largest and most advanced contract chipmaker in the world. Taiwan actually produces over 60% of the world's semiconductors and over 90% of the most advanced ones, which are used for AI, most of which are produced by TSMC. So this overdependency exposes Nvidia to structural supply constraints, as well as geopolitical risks, especially considering the rising tensions between China and Taiwan. The US has been imposing export restrictions on advanced semiconductor chips, similar to the ones sold by Nvidia, that can be used to develop artificial intelligence and related manufacturing equipment, to limit their use by China's military. This in turn has resulted in Chinese companies shifting their focus to developing homegrown AI chips, which could potentially have a considerable impact on Nvidia's future top and bottom lines given the sizable Chinese clients that Nvidia has, such as Alibaba and Tencent. The CEO of Nvidia himself, when speaking to the Financial Times on this issue, said, if China can't buy from the United States, they'll just build it themselves. So the US has to be careful. China is a very important market for the technology industry. Add to that the efforts of tech giants including Amazon, Google, Meta, and Microsoft in developing their own AI chips and cutting into Nvidia's market share, and the fact that some of them are already turning to AMD as a cheaper alternative to Nvidia's expensive AI chips, and you'll see that there's a lot to be considered when looking to buy the Nvidia stock today. Given these potential headwinds, you might want to consider a higher margin of safety. For a 15% margin of safety, the acceptable buy price would be $315. If you're looking for a 20% margin of safety, your buy price would be $297, which is over 55% lower than the current stock price. In terms of Wall Street's expectations for Nvidia stock, they're forecasting it to trade at $666 per share in 12 months, which is significantly higher than our estimated intrinsic value, but only $4 higher than the current stock price. Now, I personally prefer a 10 to 15% margin of safety for Nvidia. I do believe the company has a wide moat, a great balance sheet, and good forward-looking data. I do not own a position in the company, but I do have it on my watch list. At the current price, especially considering the risks that we discussed, I believe the stock is very overvalued, so I'll wait patiently until it drops to more reasonable prices in the future. If you would like to learn more about other attractive opportunities in the current market, please make sure to watch the next videos in which we analyze other undervalued stocks with great potential upside. Let me know in the comments below your thoughts about the stock. Do you agree with Wall Street's price target or our intrinsic value? Do you believe Nvidia to be a strong buy today? Or do you agree that the downside risks outweigh the potential upside return? With that being said, don't forget to like and subscribe, and I'll see you in the next video.